Hey everybody, it's Thursday evening. You know what that means? It's time for the weekly, or well, we didn't have it last week, but this week we're having it. It's the Financial Thing weekly live stream on YouTube. Today we have a very special guest for you. Greetings to everybody who is joining us tonight. All the usuals are here. And for anybody that's watching in the future, we hope that you'll get a lot of good information out of this chat with my guest tonight. Just a quick hi to everybody in the stream. Thank you for joining us. Tonight we have David Bradley Wood, who is the CEO and founder of Ablrate, which is a UK-based peer-to-peer lending platform. It does very specialized lending and offers peer-to-peer lending. I've written about them a little bit on the website on financialthing.com. So let me go ahead and bring David in here. There we go. How are you tonight, David?
I'm all good, my friend. Lockdown. I'm here on my own, so I've got nothing to do but do live stream with you. So
well, hopefully that's a good thing. Oh, what a mess. Yeah, let's not talk about that. It's a huge mess. But yeah, thank you for taking the time to join me tonight and to give everybody this information. We're just going to kind of go through some things have a chat about Ablrate and also the state of peer-to-peer lending and where we are right now in 2020. Tell me, David, when was Ablrate established and when was the first loan offered on the platform?
We started coding the thing at the end of 2013. So basically putting together what we were trying to achieve, and then we launched it with our first loan in July 2014, and then we launched a new platform in 2015, which included our secondary market. So that was the sort of timeline of the whole thing. We feel like old boys now in this particular.
Yeah, not so old. And I remember when I first started investing through Ablrate loans, and they were very much aircraft-based loans, very specialized. What is your background before you started Ablrate? What's your background within the lending business?
Well, I've been in financial services for the best part of 30 years in all sorts of things, from commodity trading platforms and equities. But the aircraft stuff came about. I was originally an engineer in the Royal Air Force, and I'm married to a pilot. So she's a commercial pilot, and my brother-in-law is a qualified pilot, and my father-in-law is a qualified pilot. So there's a bit of aircraftness in us all. It was towards the end of 12, I think, when a friend of mine I was getting a little bit cheesed off with the financial industry, and a friend of mine asked me if I'd help them with a leasing business, an aircraft leasing business out of Singapore. So I got into that, and then it became apparent that the particular area that they were investing in, which was 72 seaters, the thing you see flying out of City Airport, was being squeezed. So we looked at starting a fund. We started to look at various different financing methods, and that's when we came across the peer-to-peer market. We asked a few peer-to-peer platforms if they would get involved in this market, and they said no. So we decided that we would put something together ourselves. So that's why initially we started Ablrate. But obviously, I think we were a little bit optimistic that we'd be able to finance large chunks of aircraft, and so we quickly pivoted into other assets and general asset-backed transactions.
Yeah, and the airline business is taking a bit of a beating at the moment too. So it's probably a good thing that you sort of diversified into other loans. Pure luck. Just a quick disclaimer too, that this video is for informational purposes only. It's not supposed to be financial advice, and you should take its appropriateness for your circumstances. All investing carries risk, and the opinions expressed in this review video are opinions based on my own personal experience. The FSCS does not cover peer-to-peer lending or any other investments, so your capital is at risk, and please don't invest more than you can afford to lose. I always forget to do that little disclaimer, and I feel like I have to because a lot of people don't really understand, about risk. And most of our people that are watching this, David, are pretty educated, but there's always the few people that need that kind of disclaimer, I think. So getting back to Ablrate, we talk a lot in peer-to-peer lending about how companies are sourcing the loans, especially now that we've had some failures within the industry over the past couple of years. So how are you finding your loans, and explain a little bit about that and how you select the loan opportunities that you offer on Ablrate?
We have introducers. Obviously, there are people that introduce business to us that we've been working with for some time, but more and more we're becoming known, and we get more direct deals are coming to us. In fact, we're launching a new shop window in January. We're redesigning the whole front end of the website. Essentially, we haven't really concentrated too much on the borrower side. In fact, if you look at the website, you probably won't see much for borrowers. So we're rebranding it and putting a lot of emphasis on borrowers. We spent quite a lot of time with the rules that were coming in at the end of last year on policies and procedures and putting together criteria for the loans that we will do. And so if we put those to the website up front, then that obviously helps with some of the filtering processes you go through. And a lot of it is relationship building. As much as we're in the fintech business, we're in the relationship business. So it's building relationships with borrowers who lead to other borrowers, and creating relationships in the market. So that's where we tend to get a lot of our business. Yeah.
Are you pretty picky about what loans that you're actually offering now versus, say, pre-COVID? Has your criteria changed at all when it comes to choosing?
Yeah, there's definitely a COVID element to everything that you're looking at the moment. I think what we were already doing was looking at. It's funny. Some of the times when I've talked about risk, I've always said in the financials, I'm a big Game of Thrones fan. So I've always, part of my pitch, I've always said, if you're in the financial industry, at some point, at some time, winter is coming, and couldn't have been more appropriate to with this around the corner. And I'm not saying in any way, shape, or form that I predicted it, but we know that something bad is always going to come along on a cyclical basis. So we were looking at various different sectors, and we were looking at those sectors that are, people are always going to want to have their waste managed, or are going to need energy, or are going to be needing to live in homes, and so there's certain sectors that we will favour, and a lot of that is also to do with the quality of the assets that are in that particular loan too. I should have worn a mask. No, I think for me, this is often asked of us, and I think a lot of it is about pricing and optics. I think there's a lot of there is a tendency, or there is a trend, if you like, for some platforms and alternative lenders to be lending at a rate that is competitive, not necessarily priced correctly for risk. So if you are pricing a loan on the basis that you need to compete to write that business and therefore make your income on it, you're not aligned with your lenders, right? You should be pricing loans for the risk that those lenders are. I'll give you an example. We did a loan 2 or 3 years ago that was somewhere in the region of 14-15%, and another platform did a loan to exactly the same company at 7%. But on the face of it, commentators would be saying, well, a 7% loan is far less risky than a 13% loan. Well, that's not necessarily the case. You have to look at the risk and the risk of the particular loan. And if there's one thing that we've learned over the last 2 or 3 years is investing in P2P is a risky business. And so if you're going to do it, then you should be compensated for the risk that you're taking. So I would argue that we're not necessarily, when you look at us, the higher risk platform. I just think we're the higher yield platform. We're pricing our loans a little bit better. We also, I think it's important for the platforms to have financial stability. So we price for margin as well. So if a lender comes in and says, well, I'm quite happy to pay 12%, but no more than that, well, then there's no money in it for us. So we won't write that loan either. And you'll often have somebody in my office saying, well, I can get it at XYZ at such and such a platform. I can get it X% at such other platform. I said, well, go and speak to them. Because it is you have to, I think, from a business perspective, you have to have a model. You have to have profitability within it and a sustainable model. But I think it is tremendously important to price loans based on the risk that lenders are going to take.
Do you find that the borrowers who are coming to you have had trouble getting financing in other places? Is that why they tend to come to a place like Ablrate?
Not at all. And that again is something that is the assumption because it has higher rate. Often, in more cases than not, it's because they don't want to deal with the banks. They have had bad experiences with the banks. I mean, if you look at a lot of the loans on our platform, they are to group companies, to wealthy individuals that are running companies. They have an absolute, and a lot of these companies have been through the mill in 2008 and 9 and 10 with the banks, and just really can't deal with them. So a lot of the loans that you'll see on our platform, and as you've been an investor for a while, you'll see that we do a lot of loans that we know are going to get refinanced. So they'll use our lenders as a bridging finance, essentially. And it may be a 4-year loan that we know is going to get taken out by another financier in 2 years, right?
Right.
Or 6 months or 12 months. But what it does is it provides them that finance to get them where they are. And I think so. If I rebranded Ablrate as bridgingfinance.com, I don't think anyone would bat an eyelid, because essentially that is really where we see ourselves as that initial part of finance to get something done. And then we know at some point we're going to get taken out of the equation and refinanced, which is perfectly fine by us.
Right. Yeah. That's whenever you get refinancing on a loan, that's always a good thing once it's paid back, right? As long as the loan gets paid back.
Well, you're only a lender. I think the phrase is you're only a lender if you get your money back. Otherwise, you're a charity.
Yeah, absolutely. So I was having a quick hunt through your loan book, Ablrate's loan book, yesterday, and I noticed that you had one borrower developer named P1 that you had quite a lot of loans. That's something I've always been a little bit nervous of when peer-to-peer lending platforms are loaning a lot of different loans to one borrower. What's the thought process on the risk side about lending to the same person multiple loans at this, during the same periods?
Well, I can't talk about individual deals in a structural basis, otherwise we'll be here all night.
Sure.
But like I've said, we're in a relationship business. So naturally, if you end up with a good borrower who you think has got good processes and you like the way they operate, then you're going to want to do as many deals with them as you can. We, as much as we do lend to the same borrower over the platform, each loan has its own individual security package. And so one of the things about that particular borrower is they're not actually a developer. They are financiers of other developers. So underlying the loans are different developers, different projects of which they finance. And what we've done is put a structure together where our lenders can co-lend with them, and they also take a first loss basis. So we've spent quite a bit of time and legals looking at the various different structures. And funny enough, I had a conversation with them last time when they were in the office and said that it's a little bit that from an optics perspective, it's probably not a great idea that you keep calling everything P1, because really it's not. That is the structure. But it's a very good structure because we have an overarching debenture over the business. So every time we do a deal with them, essentially everybody's securities get better. So it's working out very well. And one of the things that we wanted to do was get into property. But you either take on a team of property experts and do it properly, or you work with third parties that are property experts, and those guys are tremendously good, have a tremendous track record in the industry. And so, from our perspective, it's great to work with someone like that you trust, rather than seeking new borrowers every 5 minutes and you're having to create new relationships with each individual borrower. When you can start to understand the intricacies of people's businesses better if you've got that relationship with them.
Yeah, that makes sense. And just to throw this out for you, David, people are saying that you have very white teeth. So
yeah, I think that's probably the white light that's coming through. I don't know. It's my DSL camera that is making it look that way. I promise there's no filter on it.
Oh, by the way, that loan you just put up is right. Is Camford Cliffs and Pool is say about 5 minutes from where I live. So it's interesting.
Really? You can do the due diligence then.
I will. I know exactly where that one is. So. Anything in Poole isn't such a bad. Actually, Camford Cliffs is quite a high-end residential area. But moving forward, so let's talk about 2019 and 2020 has obviously been a pretty rough year for peer-to-peer lending in general. In some cases, we've seen these companies that have voluntarily closed their doors. Some of them winding down their loan book, especially with the folding of the Funding Secure of the Lendy last year, which were the sort of higher rate paying peer-to-peer lending companies. There are going to be some people that are going to look at the higher interest rate paying company like Ablrate and say, well, what's the difference between Ablrate and those companies that have not been able to survive? So what would you say to that?
I think there are different business models that haven't worked out too well. I think one of those platforms, Lendy, I don't think anyone's going to sue me, but Lendy, was trying to do extremely large amounts of volume at higher rates, and that is a difficult business to be in, and the thing that they were looking to do that on was development finance, and if you're not on top of that. That's a tough game to be in. And I understand Funding Secure was more pawnbroking side of it, so it's a different kind of model. From our perspective, like I said before, it's not necessarily that we are, large volume, high paying site that needs to do loans day in day out to run the business. We can do a smaller volume because we have higher margins and good revenues. So it allows us to concentrate on bringing quality loans to the platform. I'm not saying we're perfect. We've obviously had defaults like everybody else, and you can't get everything right. If you're going to be in the lending business, you are going to lose money at some stage. Mm-hmm. But we're able to spend more time on each individual deal, and we do spend a lot of time building those relationships, as I talked about, that allows us to not rely on churning, things as fast as we can to try and make money,
Yeah, and I think with these company closures now, what's happening is people that were invested through the Lendys and the Funding Secures are asking themselves, how do we know who to trust now? Is peer-to-peer lending even a viable place to invest money? How do and especially for new people maybe that are looking to invest in peer-to-peer lending, how do you know who to trust, and what advice would you give to people looking to lend money?
It's a very good question, but I think the answer, as glib as it may be, is the same as any other investment: is the due diligence that you do, and if it's making sure you can manage risk I would say it because you're obviously going to ask me about ASMX, but if you've got a decent secondary market that's a bit liquid, that can give you diversification opportunities and manage risk, and importantly is to understand your own risk appetite. I think there's a lot of people that got involved with P2P that probably didn't understand the risk in quite the way they should have, and have then come a cropper when things haven't turned out with some particular platform. So I think it's important from that perspective. But I also think from the future of the P2P that it's important that us as platforms understand that we have a responsibility to provide the tools for lenders to manage that risk. We're looking in our on our new iteration of the platform to provide a risk score and to provide hints and tips and things on how you can improve your risk score and literally provide those tools and data so that people have a much better understanding of managing the risk. And I think from the perspective of a self-select platform like ours, it's a little bit easier than perhaps some of those platforms where things are a little less transparent.
Yeah, absolutely.
I think that's it. It's due diligence. It's don't risk what you can't afford to lose, and take your time. You don't take your time and get to understand and work with the platform, and after a while you'll figure out what they're like, what they're good at default, how they communicate, and I think once you do that, then you'll start to build up a trust with the platform, and that's when you can start to invest. But I would say don't rush into it, and do your due diligence.
Okay, and David, we have a question from David Dawson that says, how many people work at Ablrate? So what's your staff size, and what are your offices like?
Well, our offices are marvellous. They're on a golf course in Henley-on-Thames. So my office looks over the 8th tee of a golf course. So it's fabulous. We did have an office in London. We closed that and everybody moved over to Henley. And actually the team is only 7 people in the offices in Henley. And we have another couple of developers that are off-site. Well, probably 4 or 5 developers that are off-site. But that's one of the things that we've maintained throughout the business, is to keep it lean. So where we can use technology rather than put bodies on seats, we've done that, and that's what's allowed us to keep lean and to remain profitable.
Yeah, definitely. Some of the businesses that I've been to visit have certainly got very large operations in central London, which I can only imagine how much that is costing them a month. But have you ever had a golf ball go through the office window?
No. Funny enough, I haven't. No, I don't think there is a. I don't know. I don't think it. Some would have to do a really, really bad shot to hit our offices. I think it would be terrible to slice up the 8th.
Yeah.
Probably next time there'll be some problems with the office.
Yeah, you have to be strategically located, because if you're too far ahead of the tee and you're particularly on the right side for the old slice, that's probably not a good thing.
Well, we've been at those offices for 5 years now, 6 years, and I haven't played around yet. So it's ridiculous.
You need to get out there.
I suppose it's always that you feel you can see the office, so you always think you should be in there, regardless of when it is.
Life is short. So let's talk about one of the biggest gripes I've had about Ablrate has been the secondary market. I find it very difficult to use, and now you've introduced this ASMX, which is probably even more complicated secondary market. Just talk me through what was your thinking with the secondary market and this ASMX that you've just launched to bring liquidity to the platform.
Well, it's been in the works for 2.5 years. One of the things that we realized, if you look at our history, we launched our secondary market in 2015. We've done £57 million worth of business, and from about 47 million of that has changed hands on the secondary market. So the liquidity is there. If you look at the pandemic, those businesses that were closing their, stopping withdrawals, shutting down access to taking your money out, even closing their doors because their entire platform was a market and was relying on money coming in for money to go out, you could see when there is a liquidity crunch, there is a problem, and that is a problem in a retail marketplace. And so, we kept our secondary market going over the pandemic, and I think we traded £4 or £5 million. And so it allowed those who were worried to get out at a discount, and those who were less worried to come in and take those loans up. So it allowed us to do it. So the crux of it is that we believe liquidity is the future of this marketplace. I don't think that you can, if you look at the alternative, it's less liquidity or no liquidity, and I think that would completely rule out the retail investor. If you are investing in a loan that is 3 years, how can you plan for the fact that you are going to be in that for 3 years? You don't know what's going to happen. There's also the element of sort of risk arbitrage. If you are an investor that goes in right at the very beginning of a loan, and it's an amortizing loan, for example, over 3 years, after 2 years, the risk has dropped substantially in that loan, and so you're able to have someone who's perhaps willing to take more risk right at the very beginning can be replaced by someone at the end who really doesn't want to take any risk. So somebody who'd invest in a 25% LTV loan right in the last 6 months can buy a loan at a premium, get a smaller interest rate, but have a better risk profile, a better LTV. So there is that element that allows retail investors and every other investor to get involved in the marketplace. So the idea for this particular secondary market is that we realize that if we could allow everybody access to our platform, and I'll tell you a funny story. We know you talk about Lendy. One of the chaps who was in charge of Lendy called us and pretty much was begging for our secondary market and saying, can we have the technology? We've got plenty of people who'd like to buy loans at a discount and plenty of people who'd like to sell them. And I said, well, obviously we can't rip the technology out in time for you to make use of it. And that was the thing, is that as much as Lendy turned out to be not that great, and it's probably not a great example, if there is the ability to have a secondary market as a platform and as a lender, you have a lot more flexibility with loans. And so the idea was that we would create a secondary market that everybody could get involved with, and other platforms. So we would create the technology; they could have it as their own secondary market, and ultimately, if we can get regulatory approval, we could join those platforms together, so that you could buy a loan from another platform on the secondary market through Ablrate, or that other platform could buy a loan on Ablrate from their platform, and we would have a pooled secondary market. That means we get pooled liquidity. That means that those platforms and pooled and liquidity means that primary markets get more money. And so when we built the technology, we built it on that basis. We've built it with a protocol that allows legacy trading systems to go in. So brokers, debt traders, institutions, they can all plug into the system and trade the debt. We'll have algorithmic trading on there, so you'll be able to create an algorithmic bot, if you like, that you can program to trade individual loans, and hopefully we will allow it to trade across the market eventually. So imagine that you are now able to put an amount of money that is going to be spread across all loans on the marketplace, several platforms, different business models, maybe even different countries. So that provides a diversification, a platform diversification, a jurisdiction diversification, a market diversification, a sector diversification. So that's the general idea. We're in the early stages of it, of course, but so far it's done tremendously well. But ultimately, that is our goal: is to bring liquidity not just to the P2P space, but to balance sheet lenders. To imagine a scenario where a P2P lender could invest in a close brothers asset finance loan, for example, or a just finance overdraft loan or something like that. That's the idea, is where there is an illiquid market, we can use ASMX to provide that liquidity. It could be anything from debt to property to art, if you like. It's a liquidity engine.
How far away do you think you are from having other platforms being able to offer their loans through your secondary market?
Well, we're talking to 2 or 3 platforms. That we initially will be providing them with the technology, so that technology will become their secondary market, and then it is just a case of us making sure that we've got the correct regulatory authorizations, the correct legal structure to do it. I mean, the idea is as well that it will standardize the industry, and it comes back to what you said earlier: is how do you know that you can trust the platform? Well, if there is an entity like ASMX that is only allowing platforms that have a certain standard to be on there, and that standard will be dictated by the legals between 2 platforms, for example, and the structures. If you have somebody that is creating a standard, then you know that if they have ASMX, they've reached a certain standard and have a certain amount of scrutiny from ASMX, and if they haven't, then there is a reason for that. And so this is part of it. Is if we can standardize the industry, that makes it a whole lot easier for IFAs to get involved, for asset managers, for debt investors, and ultimately for retail investors to be able to compare apples with apples.
Yeah, yeah. And David, what's the feedback been so far about the usability of the ASMX secondary market? And for anybody who's not,
every time we launch something new, we get free advice, and it's I always call it free advice because that's what it is. I mean, there are those people who will hate anything you do. I mean, if I said to someone the other day that if I gave away free money, someone would complain. And it's true. We actually have given away some free money, and I won't tell you what it was all about, but he took it begrudgingly and wasn't happy. And so it's one of those things where some people don't like it, but it's the same sort of feedback we had with our other secondary market. People thought it was too complex, or didn't do this or didn't do that. But it's fantastic feedback. We've already done a new release, which I believe has been done today. I haven't checked, but it was being done today. And largely, a lot of that was on the feedback. Mostly, it has been around the filtering. People want to be able to filter loans on a better basis because they were able to do similar things on the previous secondary market. And so that's coming in the next release, which is probably a week or so away. But we're constantly updating it, and it's great to get the feedback from lenders because that's how we've built the platform and built previous secondary markets.
Yes, I'm just taking a little look through your secondary market here. It's very interesting. When I first started looking through it, I was like, wow, you've really created something quite complex, but I think it's going to turn into something quite very, very useful, and especially if you can provide that liquidity to other peer-to-peer lending platforms. I know that's one of the biggest gripes right now, especially within COVID, is that people cannot get their money out. And even one of our viewers right now, Annabelle, has written that she's fearful of being able to get money out of peer-to-peer at the moment, let alone putting any more in. And she was asking other people on the stream if they feel more optimistic than her. So hopefully this ASMX market can provide a little bit of good possibilities for people to be able to exit.
During the pandemic, we were obviously working from home like I am today. And we do security calls if there's any large withdrawals, and so I have to be on that duty that day. And I called the customer and I said, "Hi, how are you doing? Are you making a large withdrawal today? Just wanted to check that it was you. But this is like the first withdrawal you've made in 2 years. What's going on?" Mm-hmm. And he said, "Well, I have a couple of 100,000 with Platform X, and I'm just not able to get liquidity, and I don't know whether my son is going to need some money or whether I'm going to need some money. So I just needed some liquidity. So I sold some on your secondary market, and I'm taking it away. But don't worry, it's coming back." And that, you don't like to see money going off the platform, but you do like to see it working in the way that it should work, in that there is liquidity, and we provided probably just over 4 million of liquidity during that period, and I think people were very, very pleased with that.
Let's talk about platform risk now. I saw a comment from here that somebody said, Paul Bagworth, one of our watchers right now, said, "My biggest worry right now is not loan failure, but platform failure, obviously one of the things that go into a platform being able to survive is what's their burn rate like? Are they a profitable company? So what's Ablrate's position right now? Are you profitable? Is the company profitable at the moment?
Yeah, I mean, we've been profitable for the last 3 years. So, and we've doubled profits each year. Our profit this year is we're going to be filing the accounts very soon, and it's about £118,000 in profit this year. So, it is a bit. I think that's a tremendously insightful question, because the problem, I think, in fintech in general, not just in P2P, is that there is this trend to try to get big very quickly, and in order to do that, you've got to raise money every single year. If that is your business model, and you're relying on raising money every single year to get you through to wherever you think you're going to get to, and something like this happens, the pandemic, or there is another global financial crisis like there was in the banking crisis, you are in trouble. And we've seen that with a number of platforms. I'm not suggesting that's what happened to them, but some have been sold off cheap, some have shut their doors, some are scaling back, and it's because they're not going to be in a position to raise the money that they raised previously. So we've kept our team small. We've used technology where we can, and we are obsessed with making profit. We're obsessed with covering ourselves. So we've increased margin, which has helped us. But yeah, and this is in a pandemic. So we've done 6 months of a pandemic, and we've still made a profit. And this is one of the things, going back to what you were talking about earlier about doing how do you trust the platform and what should you do? I think one of the things is to look out. Is a platform cannot lend. I mean, we got some criticism, I think, in some industry report that said Ablrate's lending is down 32% from last year. They must be in trouble, kind of thing. And I'm like, no, we're in a pandemic. So, we're not in a position where we have to lend. I mean, we could, as a platform, we could not lend for 6 months, and it wouldn't make any difference. We would still pay the bills. Mm-hmm. So and that's not a cash burn. It could probably be 12 months. We have a revenue model that relies on the spread in the particular loans, and so that revenue comes in every single month, and so we don't have to have any upfront fees or any other revenue to pay the bills. So our profitability is not driven by providing more loans. So over the pandemic, we turned down marketing, we turned down doing loans as much as we could, and that's how we dealt with that particular period, and it was perfectly fine for us.
Okay, good answer there, David. Dave Dawson has a question for you. He says, what type of things do you hold as collateral? So what kind of things?
Well, that's interesting. I mean, we will look at pretty much anything. When I say anything, I mean, it's not going to be a Lamborghini in someone's garage somewhere, but it is generally, the stuff that we're doing generally is chattels. So it's large equipment. It is debentures over businesses. It is machinery, property. It is any sort of asset. What we like is income generating assets, of course. But one of the ways that that it's not just the asset, it's layering the security. So, I always joke that we will keep asking for security until someone says no, and then we'll make a decision on whether we want to lend against it. So that'll include everything from underlying physical assets that we can pick up and sell, to cross corporate guarantees, to personal guarantees, to third party asset security. So we will. I'll give you an example. We were talking to one guy who wanted to lend some money, and he had a factory that we were going to take some assets over, but he also had a Ferrari that he kept going on about in Monaco. And so we said, okay, well, give us the V5 to the Ferrari, and we'll put that in a secure facility, and then we'll let. And he said, no, well, that's what would I do that for? I said, well, that's the security that we want. And so it's pushing people's buttons until you find out, well, actually, really, they don't believe in this particular situation, because they're not prepared to give me that as security, and therefore we're not going to lend, because you found their particular hot button. and that may be that someone's not going to give you a PG. But the first thing that people do when they come to our office is for the first 30 minutes, they tell us how they're all going to be millionaires by this time next Thursday and how fantastic their businesses are. And then we say, well, we're not interested. What happens if it doesn't work out for you? How do we get our money back? And we're debt investors, not equity investors. So that's very much where we're at. And so sometimes it may seem that we have a sort of patchwork of security, but it's because we'll take as much security as we can from wherever we can get it, to make sure that is sometimes not just there so we can take it up and sell it. It's pressure on the directors of the company that they don't want to lose this because that's very important to them. So they'll have an extra special effort to not allow that to be taken. And most who believe in what they're doing will be quite happy for you to take pretty much whatever you want. So we keep asking until they say no, and then we make a decision.
Yeah, but they have to put their money where their mouth is at the end of the day. That's what I always say.
That's what lenders are doing. So I don't see that's any different from a borrower's perspective.
Yeah. David, Stephen Hale says he thanks you personally for being on the stream, and he says it's always helpful when deciding to invest when you hear from the guy at the top. And he hasn't invested yet, but he'll definitely have a look. So that's a nice compliment.
I appreciate it. We're pretty open. If anyone wants to ask us any questions, then we're pretty open to take phone calls and what have you. We understand that people need to do their due diligence, and we're more than happy to chat with people, meet with people, and tell them what we're all about.
So John Day says, are there usually loans available on the secondary market? So what's the availability like to buy loans?
Yeah, we've got, I think there's about 50, 60 loans, maybe 60 loans on the secondary market at the moment. I mean, every single loan that we do in the primary market goes to the secondary market. The availability of actual loans to buy is dependent on the inflows of cash at any particular time from lenders. So, in the COVID situation, there may have been 500,600,000 available on the secondary market. At the moment, there's probably 200,000, 150 to 200,000 on offer, and quite a bit of that is actually at a premium, because there's quite a lot of money coming into the platform seeking a home in the secondary market.
And John also asked David, how many loans are typically offered per month? I assume he's talking about new offerings.
It really does depend, because if we have a larger loan, our sweet spot is around about 400,000, 500,000 pounds. That's the sweet spot for a loan. Sorry, I'm not in the middle of a war zone. I think my next door neighbour is having a firework display. So it's probably 400,000, 500,000. But if we have a loan on there that's $1 million, then that will stay on the platform for whatever period of time. But we aim to have probably a couple of loans a month. But that is going to increase as we introduce our underwriter program. But that's about where we're at. Is if we do $1 million to $2 million a month, we're pretty happy.
Okay, and again, if you could hit the thumbs up on the YouTube stream, really appreciate that. We're going to try to keep this under an hour. David is on limited time today, so I'm going to run through these last few questions for David. Dave Dawson has asked, how are recoveries dealt with? A very important thing. If you could just give me a quick overview.
Yeah, you know what? It is a thing for us. We take defaults personally, so we're quite aggressive about our recovery situations. We obviously have a process. There are certain procedures that you have to do from a regulatory point of view. You have to be reasonable with your borrowers, etc., etc. But we're very, very aggressive, and we'll quite happily spend money on recoveries, because it's a reputational risk as well as individual lenders, and we pay for that too. We don't expect lenders to pay for recoveries. In recovery, any of those costs are second to investors. So we're pretty aggressive. I mean, there is a process that every lender needs to go through in a default procedure, but we are incredibly aggressive about recoveries. It's something that we find, if somebody borrows money from private lenders and then doesn't pay it back, we realize there are, business things that just don't work out. And if that's the case, then there's not much you can do about it, right? Mm-hmm. We had a default on a brewery, but the equipment and the brewery equipment, it was at the point where microbreweries were the trend. So large brewing equipment wasn't really the thing anymore. And there was a few things in the background with that particular business that the best due diligence in the world wouldn't have found out. So we had a problem there, and we had to put our hands up and say, well, there's nothing we can do about that. But in other situations where lenders have kind of just refused to pay us, we have and thought that they could just say, "I'll speak to my accountants and we'll get back to it." We've been tremendously aggressive. We did a trade finance company who owed us $600,000 and basically said, "Unlucky, you're not getting your money." But we got the money back plus default interest and fees. So it's that kind of stuff. We're pretty aggressive about it. I would say that.
Yeah, and I think it's good too. I appreciate your transparency when you're talking about, a lot of peer-to-peer lending companies. They paint such a rosy picture of their loan book, and sometimes, like you say, things do happen. But one little comment here from Gary Thomas, I thought you'd like to hear. He said he'd like to give credit to you for the regular updates that you give. I know you do video updates on YouTube. He finds them very insightful, and it's very refreshing to hear from the CEO in this space with regularity. Yeah, I like that. I think you should continue to do that. And
thanks, Gary. I mean, it was it started because of COVID. We thought, people are worried about things, and if we could, rather than send it in an email that's a bit dry, and also because there was lots of information to be imparting to people, we thought, better if, and of course with me running the firm, it's better if I'm in front of it and just explaining to people and taking people's questions and trying to be as upfront as we possibly can about the book. And it helps people understand where we're at and gives them a little less worry. And they understand that we're on top of it to whichever extent that we can be. But it went down very well, so we will continue to do those because I think they're a very good way of communicating. We get some good feedback, from people that they're asking questions from stuff on the video. So I think it's worked out well for us.
Yeah, absolutely. Paul Stitzen has asked, why isn't Ablrate in my top 5? Which is a great question. He says it looks good.
It is a good question. So why isn't it, Lawrence? Can you explain that to us?
Well, I can explain that to you. So when I first started investing through peer-to-peer, I had a limited amount of resources that I was prepared to risk. And as the list became bigger and bigger, it became harder to move resources from one to another because of the lack of liquidity. And I think I just personally got a little bit gun shy from what happened with the other high interest rate lenders like Funding Secure, to where I was really sort of in a wait and see pattern. It's definitely more about being gun shy and having lost days.
It's understandable. It comes to the point where and like you said earlier, if you look at Ablrate and you go, oh, it's a higher paying platform. Just on the face of it, if that is your criteria, well, they pay too much money, so it has to be risky. I think I'll go to a platform that is less. I think that is a natural reaction, but I think it's worth people perhaps giving us a second look and seeing the stuff that we do. And I think again it comes down to pricing, and I think we do pricing.
Yeah, and also another reason was just because the amount of time that I thought I needed to put into loan selection, I didn't have it at the time. I was working on this business. I was spreading money across 20 different platforms, and manual lending was becoming more of a difficulty for me to handle. So I started to look more at the auto invest side of things just for time constraints. So unfortunately, that's just part of what comes along with Ablrate, is you do have to do some due diligence, and time was a factor. So. But if you like picking out your own loans, I mean, Ablrate's a great place, and you do provide a lot of information. So I just have to win the lottery so I have more money to be able to put into these different platforms. There's so many now. We got about 10 minutes left with you, David. let me ask you about the state of peer-to-peer right now. What do you think is going to happen to the industry over the next years? Do you see a contraction still going to continue? Do you think it's going to flourish? What's your opinion?
I think there is room for peer-to-peer, that's for sure. I think there's going to be problems. I think the whole reason that it started off in the first place was because of the banks and the problems with the banks lending, and I don't think that's going to go anywhere anytime soon. Even with 80% guarantees, they're not lending from the government. So I think from that perspective, there is a marketplace for it, but I do think there has to be a level of standardization and a level of I think I was asked today, funnily enough, by the P2P Finance News, that an article they're doing on some of the regulations and what I thought about where the regulation is. And I think we're in a reasonably good place with the regulation. A lot of people were talking about the December regulations that came in about appropriateness tests and that kind of stuff, and some of the stuff that didn't get the press, like you have to show your homework when pricing loans, and I thought that was very, very good. So I can see the trajectory of the FCA moving to perhaps more descriptive, more information on products. I think things like access accounts, where people are saying you're going to get 30 days access and stuff like that, I think that the FCA will start to scrutinize that, because we've seen that you can only see who's swimming naked when the tide goes out, right? So as soon as there is a lack of liquidity, those kind of products are not really the ones that retailers should be involved in. Not probably the wrong way to put it. I mean, there are some great companies that do that sort of stuff, but I think a lot of people got into it on the basis that it was more like a savings plan than it is a P2P scenario. So I think those kind of things are going to be highlighted by the FCA. But I think as we standardize, as things like, and I would say this, but as things like ASMX come in to help liquidity, as the industry becomes more standard. I mean, I saw your interview the other day with Mike at Crowd Property, and you have platforms like that are now coming through, super professional, really good, really, really great guy over there, a good team. And it's those kind of businesses that are going to do very, very well over this period of time. If you've got a good model, if you're making money, if you've got good procedures, then there's definitely a place for it. I think it might be difficult for new people to come in, because the regulatory burden, the marketing burden, and the competition now is perhaps perhaps a bit tough. There's probably room for some more niche players, I think. But certainly there's a place for the industry. I've got no question about that.
So it sounds like, I'm going to put you on the spot for a second here, David. Since you mentioned Crowd Property, and the people that watch this stream are always asking me, who do you think is a viable place to put money? If you take Ablrate out of the picture, and of course this is not recommendations, this is just purely information, personal opinion, would you put yourself on the spot and say, I think these companies are doing well and they're doing good things within the peer-to-peer lending industry?
I think the guy. I've met quite a few of the guys. I met Mike just before the lockdown, and he's a tremendously professional guy, and the right attitude about it. And I think there are others out there who are in a similar vein. I think there are some platforms who have learned from their mistakes and perhaps are not given enough credit for moving forward. But there are also some platforms that are super professional. I think everybody can see that there is a roadmap to being successful, and that roadmap is being transparent. It's it's having good procedures, good processes. It's making money. It's been a viable business. And I think there are a few out there that are like that. I think there's a few that won't make it because their business models are not robust enough, and they're trying to compete in the wrong marketplace against people that have got far more money than they have. But ultimately, I think there's some really good platforms out there.
Okay. Dave Dawson is asking how quickly new loans get taken up. This has been an issue on a couple of platforms, that the loans just taken up so fast. So if you have a larger account balance, you just can't seem to get invested.
Yeah, we've done. We had, last year it was, we would fill a loan, 500 grand loan in 5 minutes, 10 minutes. It slowed down a bit over the COVID situation. Um, so there is generally, you have a generally good period of time to get into a loan, especially the ones that when we do the bigger loans. But if we think that there is a loan that's coming that is particularly popular, we've done a certain amount of things after this 5 minute situation. We give a 2 hour waiting time, so you can't bid on it within 2 hours because we were terrified that the FCA would come in and say, how can anybody possibly read all the information in this loan in 5 minutes and invest? So we have a 2 hour time for you to contemplate and to read the documentations and make some decisions. And we also have the ability to limit bids, so we can put a 3,000 bid or 1,000 bid or whatever for a period of time, so that at least it gives some of the smaller investors a period of time to be able to fill their boats, and then it's a free for all for anybody who wants to invest larger amounts.
Okay.
And there's maybe an auto investment tool coming in on the primary market as well to help with that.
Okay, and Scott Peacock has asked, what percentage of the loans arranged to Ablrate invest themselves in? So I'm wondering if he's asking about, is there skin in the game involved, maybe?
We don't. And I'm not sure that I keep saying it's a regulatory situation where you're not allowed to, but there are other platforms that do it on the basis of third party participation in a particular loan. But from our perspective, if we were in a position to be able to invest in the particular loans, we would. But we are aligned with our lenders on the basis that most of our revenue is based on that loan completing its term. So we get paid a spread on a monthly basis. And if that loan defaults, remember, we're paying for the legals to get that money back. So there is an alignment with our lenders. We feel that we're not just churning out loans because I always worry if there is loans or a firm that is relying completely on upfront fees, because then your business model is churning out as many loans as you possibly can.
Right.
Whereas if they are more of a spread model, your alignment is churning out quality loans, because your long tail income is going to be more from the spreads, which is exactly what we've been able to do. We probably have 1.8 million pounds worth of long tail income that is due to us from our loans presently.
Okay. All right. Well, David, we're going to come about to the end. Anything else that you want to say to our esteemed viewers out there?
Well, I appreciate people coming over, people listening to us chat tonight. We've got a couple of things coming up soon. We've got our new UI that's coming out, which hopefully will be out in the next few weeks. We're also launching a black box lending situation. Look, we get some people that come to us, like you just said, they don't want to press buttons and they don't have the time. But this is initially going to be launched for sort of high net worth people. So it's 50,000 minimum if you've had advice and 100,000 minimum if you haven't. And it's a sort of test for our underwriter program. So we're looking at creating more loans, but to do that we have to be more certain about the capital. So we're going to use that facility to do underwriting of loans, and that will allow us to do some loans quicker and scale up origination as well. So we're looking forward to doing that, and obviously we're rolling out some more changes with ASMX, and we're really looking forward to speaking to other platforms and getting it out there and completing on that particular mission.
Okay, one quick last question we'll let you answer before you go. Mike Powell says, do you charge borrower default fees or interest? Who gets this? He says it's a bit of...
We charge default interest rates, and it's generally it is the lenders who get the default interest. If we can recover our legal fees, then obviously we do the best we can to recover our legal fees. If it's a solvent recovery where it's a roll off of the loans, then the interest would go to the lenders. But remember, we'll always have that spread in. So if a lender is getting 12 and the default interest rate is now 15, we'll still have our 4% on top. So it'll now be 19 to them. So the default interest gets paid to the lenders, but we still take our margin on top of that. And that's the price of defaulting on a loan with us, I suppose.
Yeah.
But we do, the fees and the default fees, they do go to lenders. We also capitalize interest. So if they've missed a payment, then we will capitalize interest to the loan. So which is a typical thing that we've done during COVID. Is we're not going to write off the interest. We're going to capitalize it into the loan amount so that interest is ultimately paid.
Okay, great. Okay, David. Well, I'm going to thank you very much for the time. If anybody wants to go check out Ablrate, that's ablrate.com. You can go sign up for an account, check out the platform, see what you think, and wish you well, David. Will you come back and join us again in the future for an update?
Yeah, it'd be a pleasure.
Okay, perfect. Well, you have a great evening. Be very safe. And again, thank you so much for your time. Really enjoyed getting to know about Ablrate. And you're always very outspoken, and I like that. You're very transparent. You're not afraid to put your opinions out there. So that's always appreciated. So thank you very much.
Something I said tonight as a headline in P2P Finance News tomorrow, no doubt.
Probably. All right, David. Well, thanks for joining us. Okay.
Cheers. Bye-bye.
Bye. Well, so there you have it. That is David Bradley Ward at Ablrate. I like David because he is very outspoken and he's not afraid to say how it really is out there. And it's becoming so much more difficult now to know which platforms are on the up and up. And so when you have somebody who's willing to come on and sort of lay it on the line, I appreciate that. So what I've decided to do regarding guests, I put a poll up on the Facebook group. By the way, if you want to join the Facebook group, please go ahead and do so. You can find that pretty easily as searching on Facebook. But I put a poll up there about how often people wanted to see guests on the stream, because I don't want the stream to be an advertising platform. They're not paying to come on here. These are people that I generally want to talk to, and I figured once a month I think is going to be the frequency that I'm going to have these peer-to-peer lending guests on here. And it's usually going to be the CEO or somebody running the companies. I want to get the real answers of what's going on. So I think once a month, maybe twice a month in certain circumstances, but I think that's going to be enough. If my memory recollects me correctly, the next guest is going to be the CEO of Cufflink, Navinda, and I think that's going to be next month. So yeah, let me know what you thought about the stream too. If you enjoyed the interview, if there's anything that you have comments or questions about, put them in the comments down below. And to anybody wondering, yes, I had a wonderful holiday. I went out to Montana here in the USA and did some nature hiking and out in the Yellowstone National Park, but it was nice to get away. And next week we'll be back to the same format as usual, sort of wrapping up the peer-to-peer lending news for what's happening in the week and in the industry. As far as personally and what I'm doing with my lending, I'm kind of sticking towards the same companies that are really on my top 5. I've been a little bit swayed with this week with the Ablrate interview. I think David's doing some good things, so maybe something that I'll expand upon with my own peer-to-peer lending in Ablrate. I just don't have a lot of time to do manual lending at the moment, and their loans are their loans are very manual based. You have to select your own loans for the most part, and time for me is an issue at the moment. But I do like what David's doing over there, and he seems to have a good grasp of what it takes to be a solid lender out there. So I was kind of impressed. Just a quick bit of news about lending work, and they were the first companies to say that they're going to be in a period of offering negative interest rates to lenders. Yeah, it's really not the greatest of situations, unfortunately. The one good thing I'd say about LendingWorks is that they were acquired by a capital company in July, so there hopefully is money behind them for whatever it is they're going through. If anything, I don't know for a fact if they're having particular issues, but I do know that I was totally expecting that their loan book was going to suffer during COVID because it's an unsecured lending loan book, and those are going to be the first people that run into troubles during a period of economic downturn. So I'm not truly surprised by that news. I was a little surprised by the whole negative interest rate situation, but I've always said that if it takes a company having to go negative interest rates for a while to help their business survive, I'm okay, because capital preservation is the most important thing. I'm not so concerned about receiving 3 or 4 5% interest at the moment due to what's going on. But not the greatest of news. We'll see what happens. And yes, we are in the middle of this mess of a US election, it's very interesting too what's happened with the stock market. I didn't think that we would see a positive stock run this week in the markets, and we've seen it little bit in the FTSE up today, but the S&P is up almost 2% today. So I presume that the markets believe that Donald Trump is going to be victorious in the election, but who knows what's going to happen. I think this is going to drag on for the next few days, and there's probably going to be a lot of lawsuits flying around. And then you'll see some kind of market stabilization, hopefully, within the next couple of weeks, depending on who wins. Personally, I think if Biden wins, the market's probably going to be negative, and if Trump wins, it'll go positive. But we'll see what happens. Well, that's going to do it for the stream this week. Thank you, everybody. All the usuals are here. We've just a quick shout out. Stephen, Hale, Nottingham, Akichap, of course, is here in Accrington. Paul Bagworth and Kenilworth, Norman in Sussex, Peter in Leatherhead, Dave, as always, is here. David Dawson, Keith Morris in Lincoln, Colin in the Peak District, John Mulholland is here, Paul Stetson, and Arthur Ackerson in Belfast, ES here in Portugal, Scott from Stavanger. I've never heard of Stavanger. I'm not really sure where that is, Scott, but I have to look that one up. We have Stephen Green here, John Cutler. So some new faces, Sue Lund. I hope you enjoyed the stream, everybody. Sorry about the little bit of audio drop out there. I've got a new system here that allows me to kind of scenes here, so I'm still learning, how to use that. But I think the stream is getting more professional, so I really hope you're enjoying it. The white teeth, by the way, are exactly what David said, because we got this white light blazing on me, and he had one too, so it makes our teeth look white. But it is definitely somewhat because of the salt toothpaste. I think I'm going to do a video on some of the things we talked about health products and things. Hi, Annabelle in the flooded Spain. Hope you stay dry out there. And John Day is here, of course. And Eamon McMahon, he also said from his experience, Ablrate secondary liquidity is good and provides good control to investors. I think the ASMX market is very interesting. If they can bring in other peer-to-peer platforms onto that ASMX market, essentially that would mean that you might be able to sell loans from different platforms on this market. That could be a game changer for peer-to-peer lending, because liquidity is everything right now. So if other platforms are able to be integrated, that would be extremely, extremely exciting. I wasn't quite sure about what they were doing with regards to other platforms being able to sell, so I think that's pretty exciting. So hi, John Fleet and Rek Nep Schmag. It's a very difficult one for me to pronounce. Apologies if I butchered it. But yeah, if you have any other comments, put them in. We're going to wrap up in a couple of minutes and say goodnight. I'll be back next Thursday. No guests next Thursday. Nice to see you, Mike Powell from the Action Group. Although if you haven't joined the Action Group, Lendy Action Group on Facebook, you can find them very easily by searching And I think that is going to do it this week. We'll see you next week, next Thursday at 7:30 p.m. Everybody have a great week. Be safe out there. Enjoy your friends. Enjoy your family while you can. By social distancing, of course. And we wish you the best safe health. And remember, there's more to life than money. Get out there, live, love, laugh, and enjoy your life. Take care. We will see you soon. Bye.